KLA delivered what most companies would call an outstanding quarter. Revenue beat expectations. EPS came in above consensus. Management even raised its outlook. Yet the stock still fell. At first glance, it looks like another case of Wall Street demanding perfection. But after reading the entire earnings call transcript, I believe the market missed the biggest message. The real story wasn't hidden in the financial results, it was hidden in the words management kept repeating. And if they're right, this isn't just another earnings report. It could completely change how investors should think about KLA in the age of AI. Let's start with the facts. KLA reported revenue and earnings that both came in above Wall Street's expectations. Management also issued stronger guidance for the next quarter and even raised its outlook for the wafer fabrication equipment market to the low $150 billion range, reflecting continued confidence in AI-driven semiconductor investment. If you looked only at the financial results, this should have been a positive earnings report. Yet the stock still sold off. That tells us something important. The market wasn't reacting to what KLA reported. It was reacting to what investors had already expected. And when price action contradicts improving fundamentals, that's usually a signal to dig deeper. Because the most valuable insights are often hidden where the headlines stop, and that's exactly where the earnings call begins. As I went through the earnings call transcript, one pattern immediately stood out. Management rarely talked about semiconductor cycles or wafer volumes, the metrics investors have traditionally used to evaluate companies like KLA. Instead, they kept coming back to one word: complexity. That wasn't accidental. It reflects a fundamental shift in how KLA creates value. AI isn't just increasing the number of chips being manufactured, it's making every chip dramatically more difficult to produce. Technologies like gate-all-around transistors, high-bandwidth memory, chiplets, and advanced packaging require far more inspection and metrology than previous generations. In other words, KLA's future growth may no longer depend primarily on producing more wafers, but on the fact that every wafer now demands far more process control. And that's the message I believe the market largely overlooked. For decades, the growth equation for semiconductor equipment companies was relatively simple. If chipmakers built more fabs and produced more wafers, equipment suppliers sold more tools. But KLA is telling investors that this equation is changing. According to management, the next phase of growth isn't being driven by wafer volume alone, it's being driven by manufacturing complexity. AI chips require technologies like gate-all-around transistors, high-bandwidth memory, chiplets, and advanced packaging. Each of these innovations adds more inspection steps, tighter process control, and higher metrology requirements. In other words, KLA doesn't need every customer to manufacture significantly more wafers. It benefits because every advanced wafer has become significantly harder to manufacture. And if complexity continues to rise with every new generation of AI chips, KLA's growth could become increasingly structural rather than purely cyclical. One of the most important insights from the earnings call is that AI is changing the economics of semiconductor manufacturing. In the past, scaling performance often meant shrinking transistors. Today, that alone is no longer enough. Leading-edge AI chips combine gate-all-around architectures, high-bandwidth memory, chiplets, and advanced packaging into a single, highly integrated system. Every additional manufacturing step increases the probability of defects, making process control more critical than ever. That's exactly where KLA operates. The company isn't competing to build the chips, it's enabling customers to manufacture increasingly complex chips with higher yield and reliability. As AI systems become more sophisticated, the value of process control grows alongside them. This is why management believes the opportunity is expanding, not because AI requires more chips, but because it demands much better manufacturing precision. If there was one business that management sounded especially confident about, it was advanced packaging. In fact, KLA expects its process control revenue in this segment to grow by more than 70% year-over-year. That's a remarkable number, and it reveals where the next wave of AI investment is heading. As GPU performance improves, the challenge is no longer just building a faster chip. It's connecting multiple chips, high-bandwidth memory, and advanced substrates into a single package with extremely high precision. Every one of those manufacturing steps requires inspection and metrology to prevent costly defects. This is why advanced packaging is becoming one of KLA's fastest-growing opportunities. While many investors remain focused on wafer fabrication, management is signaling that the next phase of AI may be driven just as much by packaging innovation as by transistor scaling itself. Another important message from the earnings call is that AI demand is no longer concentrated in foundries alone. Management highlighted that investment is now expanding across the entire semiconductor ecosystem. High-bandwidth memory is becoming essential for AI accelerators. Advanced DRAM is seeing stronger demand. Advanced packaging continues to scale rapidly. Even leading-edge logic devices require increasingly sophisticated process control. This matters because it broadens KLA's addressable market. Instead of relying on a single customer group or one part of the manufacturing process, KLA is positioned across multiple technology transitions happening at the same time. As AI infrastructure grows, the company has more opportunities to participate throughout the semiconductor value chain. That's a stronger growth profile than a business tied to just one segment of the industry. KLA's competitive advantage isn't built on selling the largest number of tools, it's built on solving the industry's most difficult manufacturing problems. That's why the company consistently generates some of the highest gross and operating margins in the semiconductor equipment industry. As chip designs become more complex, the cost of a manufacturing defect rises dramatically. For leading-edge customers, missing a tiny defect can mean losing an entire wafer worth millions of dollars. In that environment, process control is no longer a discretionary expense, it's a necessity. That gives KLA significant pricing power and reinforces its competitive moat. The more complex semiconductor manufacturing becomes, the more valuable KLA's technology becomes. In other words, AI isn't weakening KLA's moat, it may actually be making it stronger than ever. Another part of the business that often receives far less attention is KLA's services segment. Once a process control system is installed inside a semiconductor fab, the relationship with the customer doesn't end. Those tools require software updates, calibration, maintenance, spare parts, and ongoing technical support throughout their operating life. As KLA's installed base continues to grow, so does this stream of recurring revenue. More importantly, service revenue tends to be less cyclical than equipment sales because customers must keep their production lines running regardless of the investment cycle. This creates a more resilient business model, stronger cash flow, and greater earning stability over time. While investors often focus on new tool shipments, management is quietly building a recurring revenue engine that strengthens the business year after year. After reviewing both the financial results and the earnings call, it's difficult to argue that KLA disappointed on fundamentals. Revenue beat expectations. Earnings beat expectations. Guidance moved higher. The company even raised its outlook for the wafer fabrication equipment market. Yet the stock still declined. The explanation lies in market psychology rather than business performance. Over the past year, investors have priced AI-related companies for near-perfect execution. In that environment, simply delivering an excellent quarter is no longer enough. The market wanted exceptional results that would dramatically raise future expectations. When those expectations weren't exceeded by a wide margin, investors took profits. In my view, the sell-off says more about elevated expectations than it does about any deterioration in KLA's underlying business. This brings us to the central question. What if the market is still evaluating KLA with an outdated framework? For years, semiconductor equipment companies have been valued based on wafer starts, capital spending cycles, and memory recoveries. Those factors still matter, but management is pointing to something much more structural. As AI pushes semiconductor manufacturing toward greater complexity, process control becomes increasingly essential, not just during periods of capacity expansion, but throughout every major technology transition. If that thesis proves correct, KLA's long-term growth will depend less on how many wafers are produced and more on how difficult those wafers are to manufacture. That is a fundamentally different business model. And if investors continue to think cyclically while the business is becoming more structural, the market may be underestimating KLA's long-term earning power. At the beginning of this video, I said the market missed the biggest message. After reading KLA's earnings release, listening to management, and studying the entire earnings call, I believe that message is now clear. This wasn't simply a story about beating revenue estimates, delivering stronger earnings, or raising guidance. It was a story about a business whose growth engine is fundamentally changing. As AI drives greater complexity across semiconductor manufacturing, the demand for inspection, metrology, and process control is becoming increasingly critical. That shift has the potential to make KLA's long-term growth less dependent on semiconductor cycles and more closely tied to the rising complexity of every new generation of chips. In the short term, the market may continue to focus on quarterly expectations. But over the long run, businesses that solve increasingly difficult problems are often the ones that create the greatest shareholder value. The market saw another earnings report. Management described a different business. And that may be the biggest message the market is still missing. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.